Good morning, everybody. Welcome to our latest in the FPRA webinar series. It seems quite a long time since we've done one of these because obviously we were very busy with our annual general meeting, and it was great to see so many members and supporters and all our sponsors at our AGM last Wednesday. Today's webinar is a life in block management with our honorary consultant, Sally Drake. Good morning, Sally.
Good morning, everybody.
Lovely. Thank you for joining us and agreeing to do this with us this morning. As usual, in the background, we've got Caroline, who runs our admin office, will be moving the slides as we go along. Morning, Caroline.
Good morning, everyone.
Yeah, and Jackie will be monitoring your question and answers as they come in. You'll see at the bottom of the screen a Q&A section. So if you've got any supplementaries to questions that either you've asked or others have asked, then please pop your Q&As in there, and Jackie will be notifying me as and when those come in, and we'll try and deal with those as we go along. So morning, Jackie.
Good morning from me.
And John Ray is in the background, who will be making sure that the recording works and hopefully the technology works. Morning, John.
Good morning to everybody.
Lovely. Okay, so if we're all sitting comfortably, as the phrase goes, we've got about 15 participants, I believe. We've got a message straight away from the Garden Court Residents Association. Good morning. Thank you for joining us. The recording will be available within probably the next 24 hours or so. John will make that available for members only, which you'll be able to access with your member ID on the website. So our session this morning is called A Life in Block Management. As I mentioned, we've got Sally with us, one of our honorary consultants, who's an expert block manager. And I will kick off, Sally, with question number one. I would like to understand freeholder responsibilities when the block is managed under a RTM, a right to manage arrangement.
So it often depends on how the estate is. So if you are just, say, the sole block and all of the estate grounds are within what you would describe as the demised responsibilities within the lease, then the right to manage company is effectively responsible for pretty much everything in regards to maintenance and repairs to the estate. If you've got an estate where you've got different blocks, the right to manage will always apply to just a singular block, unless they can in some way be proven to all be part of the same building. In situations like that, you can often get multiple right to manage applications, and sometimes they take a view to segregate the land into what they would consider to be reasonable assumed areas of responsibility for the externals. But often when you have an estate that's split like that, there will be what you'd call like a tiered arrangement, and the freeholder may still retain responsibility for the external areas. That's where you've got a split estate. Where you've just got an estate and a freehold that is one building and its surrounding grounds, the lease will describe what the responsibilities are. And if the lease does describe leaseholders contributing towards the grounds, then it is assumed that the grounds would be within the right to manage responsibilities, because essentially you take hold of all rights and responsibilities for all types of maintenance and foreseeable future cyclical repairs. So you'd be responsible for your budget and your capital expenditure plans and things like that. But what doesn't get transferred over is any right to receive ground rents. You sometimes find that in those situations, the freeholder may also decide to retain the right and responsibility for arranging the building's insurance. And that can be a frustration, because we all know that buildings insurance is one of the most expensive parts of the service charge. And when it's with the freeholder, they can have a habit of making agreements to keep the premium low, but which doesn't necessarily serve the leaseholder well, because it means there's very high excesses applied, so that your premium's low, but should you ever need to make a claim, the amount that you have to pay in excess can be quite extortionate. So I've got a block where we're under this type of arrangement where it's a block that has the right to manage, but it's still freeholder owned estate. They arrange the building's insurance, and the current excess for an escape of water is in the region of £1,500, even if it's flat to flat. This is not the building excess as a times units sum. This is the singular flat to flat escape of water excess that is applied. And that's been agreed without any control of the managing agent or the management company, because it's something that the freeholder has retained the right to do. What they also won't be involved with is, what they don't pass over is the management of any non-residential parts of the building, or flats that don't qualify for whatever reason. They say they're not let on the same terms as the rest of the flats in the building. And if they are retained by the freeholder themselves, then obviously the freeholder retains responsibility for the management of their units. But as a general rule of thumb, you can assume that as a right to manage company, you would be responsible for pretty much everything, but it is down to how things are described within the leases for the flats. So like with everything with leasehold management, the first port of call is to always know and understand the content of the lease, because that is the guiding, that's the guiding book for anything that's correctly managed has to be done in accordance with the terms of the lease. So you'll find your right to manage responsibilities will be based on your lease, and that's how the right to manage agreement should have been agreed at the time that the application was processed.
Thanks for that, Sally. I think that's a really important point to emphasise. It's always a case of reading the lease, and as FPRA members, that's why we always ask for a copy of your lease to enable us to get the best possible independent advice for you. I know in my block, I'm chairman of an RMC company, and our external freeholder had the rights for the insurance. I challenged them informally, actually, and we were very successful in them bowing to let us arrange the insurance. That was some 15, 20 years ago, and we've done it ourselves ever since. But the lease still hasn't been changed. So it's just something that's worth always negotiating with the freeholder. It's worth emphasising, of course, that the point about ground rents, that's about to change. The ground rent bill, soon to become an act, is going through Parliament, which will take away the benefits to freeholders for maintaining the ground rents, because they'll be no longer an asset. Of course, one of the things we've campaigned for a long time is abolishing insurance commissions, because one of the things that will remain will be the insurance commissions, which are quite often not insignificant amounts of money. And as you rightly said, Sally, that's actually skews actually what managing agents charge or perceived to be charging, because they have to obviously have to factor in very large commissions, and very often freeholders, use that to sort of skew the property management market, which is often very, very frustrating. Do we have any questions, Jackie?
Yes, we do have one in the chat from Amish, who's just saying that their lease is 999 years. And I believe he means they have 958 years left, and the lease is very complicated. So I was just replying to say if he has any specific interpretations that he would like, if he emails the admin office, then we will see what we can do to try and interpret some of it for him. But obviously, if you have any response.
I think that probably is a question to take offline, isn't it, Sally? I think.
Yeah, I'm not too sure what the question was in particular. What was the point that was being raised that to be addressed?
Just saying that it's complicated. So I'm saying, let us know what you want explained, and we'll do our best to do it.
Absolutely, yes.
Yeah, I think that's definitely one to sort of take offline. So do please drop us an email, as always, info@fpra.org.uk. If we can move to question number 2, please, Caroline. What is the role of the managing agent, and where do the boundaries of the role end?
So this is an interesting one, because I've had background in both the public and the private sector. And in the public sector, so if you was, for example, a long-term leaseholder, because you'd purchased through the right to buy process with your local council, or the right to acquire process with a housing association, or shared ownership, you find that the managing agent will be more involved, because there's a higher expectation of the service. But when it comes to private sector, essentially what the role is the management of the bricks and the mortar and the management of the legalities that are involved with freehold and leasehold tenures. So where those boundaries blur is where there is a need for the block manager to be involved with the human side of block management. It's technically not what a block manager role is. A block manager is there to make sure the building is maintained, to make sure that the contracts are in place, to make sure health and safety risk assessments have been completed and the building is meeting all the current regulationary standards for compliances for key issues like health and safety, fire safety. You need to make sure that you have your utilities checked and maintained in the periodic requirements, for example, your 5-year electrical testing. And these all fall within the boundaries of the managing agent role. We are also there to protect the client and make sure that all the legalities that are placed on the management company or the right to manage company, or where the freeholder is our client, obviously their responsibilities and their roles are covered. Our job is to protect those interests, and that's the main thrust of what we do. So we manage the finances, and we are also expected to have a view to the long term so that we can advise our clients on where there is a need to assess the life expiry of components of the building so that you can put together practical reserve funds and collect at reasonable rates that are affordable. There is a need to keep the leaseholders happy, but first and foremost, the managing agent has to represent the client, which is in most cases the directors of the resident management company or the right to manage company. So you are effectively looking after the leaseholders because the clients are there to represent the leaseholders who are members of said companies. So it's not as simple as to say we manage the bricks and mortar. Even in the private sector, there is often a need for getting involved with issues that are from flat to flat, because we need to be the party that's got the legal right to handle data. So we can contact the leaseholder above, whereas we can't just give contact details for that person above to the affected party. So, and often we get involved in things like noise disputes, which technically may not be part of the specific managing agent role, but it would be impractical to try and manage a block effectively and deliver a good service to your clients if you didn't assist and take some part in helping to resolve those issues as they arise. So a good managing agent, a dedicated managing agent, will be more than happy to manage both your bricks and mortar and the interpersonal issues that come up in the effective management of the estate. I mean, there are some things we won't get involved in. And there is a point at which we have to draw the line, because we do have to make sure the time that we've got that we can allocate to each of our clients within our portfolios, we have to make sure that time goes to getting the essential parts done. And then we try to make time to deal with everything else. But our main key responsibilities are the upkeep of the building, the management of the finances, and the management of the legalities, and everything else falls in around that. And sometimes it does mean that we can't be as involved as we'd like to be, if it would mean sacrificing time spent for the compliances and the necessary vital parts of the role.
Thanks, Sally. And I think it's worth saying one of the things that I know many agents have found frustrating over the last few years is the lack of regulation. And I know there's talk about having a statutory regulator for property managers, and certainly from my perspective, that can't really come too soon now. ARMA, sort of the trade body, the Association of Residential Managing Agents, have done their best to try and sort of fill that void, haven't they, over the last few years? But without a statutory regulator, and I think with more and more responsibilities falling on those who manage properties, obviously we've got the Fire Safety Act that was came into law this year, and then obviously the Building Safety Act, which is, or the Building Safety Bill as it is at the moment, that's going through Parliament, is going to place even more duties on managing agents. So I think having an independent regulator would be beneficial. What do you think, Sally?
Absolutely. it's crying out for more regulation in this industry. There are some very good managing agents out there, and there are some very unscrupulous managing agents out there. And you can't always rely on things like Google reviews, because you do get a lot of manipulation of these types of online forums. The best thing that I can say to anybody that might be looking to change their managing agent is word of mouth. People that have actually had real-time experience. Don't necessarily trust online reviews because they get utilised, and you often get people will only go online and say something if they're really unhappy, and you don't actually get a balanced view of just how good a service might be just because one individual is particularly disgruntled and takes the time to leave a review. That said, you can't completely disregard them. So as I say, the most reliable source to really find out if they do a good job is to speak to people that have got managing agents and see how they find their managing agent to be.
Absolutely. I noticed we've got a couple of questions in the Q&A for you. What the first one is, what is the basic approach to move from a RTM to buy the freehold enfranchisement?
Well, the first thing you need to do is apply to the freeholder to see if it's something that they are open to. I know when it comes to right to manage, it's not always the same process as it would be for a resident management company because of the grounds on which obviously the right to manage company is something that's created by the leaseholders that are already existing, where the resident management group company would be written in and created at the point of the lease formation. So the first thing to do is to approach the leaseholder, to approach the freeholder and raise your interest and see if they would be prepared to go through Section 5 and consider selling the freehold.
Excellent. And as Philip Rainey pointed out at the AGM last week, of course, you know, that actually all you're doing is shifting the responsibility onto other residents, really. The directors will have responsibilities for a right to manage company. But actually people, you know, live in buildings will cause, you know, contention. So it's not always a straightforward approach, but, you know, obviously having a share of the freehold probably is preferable to an RTM, I would suggest. And then I've got a second question. I have owned and lived in leasehold properties for almost 20 years, and I've yet to come across an estate management company that does an acceptable, let alone a good job. On the estate we currently live on, we have had 3 management agents since the estate was built 11 years ago. All management agent companies tend to talk the talk, but none, in my experience, walk the walk. How do we identify managing agents that is competent and will walk the walk?
As I said before, word of mouth is often the way forward, because that way you can trust the reliability of the people that you're speaking to, and you're not just reading good reviews that have been generated by somebody that's been paid to leave those reviews online, and you're not also being influenced by people that are not necessarily coming at the angle from a good heart and are just disgruntled because in fact they've done something wrong, which we do often find to be the case. Of course, you can look to ARMA accredited companies. There are certain criteria that needs to be met. So you may have a new company that's, maybe I'm in the middle of remembering now. Sorry. As I was saying, sorry about that, it was my other half. He obviously didn't realise the webinar had started. I did tell him not to come in the front room. Sorry about that. As I was saying, ARMA Q. So ARMA accreditation is something that managing agents sign up to so that they are upholding the standards that have been set by this third-party body that's been created to make sure that standards in block management are in place. And whilst there is an application process, and so newer companies can't join until they've had at least 2 years of trading, it is something that managing agents are more and more encouraged to do, because more and more resident management companies are looking for that accreditation to be given to the agent that they then choose. My company is in process of going for that accreditation because we are quite a fledgling company. As I say, it's not guaranteed, because as with many things in life, it's often down to the person that's allocated management of your estate. The chain is only as strong as its weakest link. If you get a good block manager, you will find you get a good service. If you get a weak block manager, it doesn't matter how good the rest of the company might be, the block manager themselves is the person responsible for delivering that service. So it is a hard one to do, other than by word of mouth, where you've got people's real-time experience of the managing agent. But as a guideline, if you're looking for one of the bigger companies that's been established for a long time, then Armour certainly is a place to look to for checking whether the company you're considering is accredited or not. And if they are accredited, it means that they are agreeing to uphold certain standards that have been set by external bodies that regulate and monitor the industry.
I think that's a really important point. In the absence of a statutory regulator, Armour, which is soon to be merged with IRPM, which is the organisation that provide the training for property managers, are merging, and at the moment they are the only show in town, as it were, really. In response to word of mouth not working, obviously that's unfortunate. Certainly, one of the things that I would always recommend to people, is have a look around your local area, and you will almost certainly see blocks that you will think look like they're well managed, because actually they'll be well maintained. The gardens and the external areas will look nice. If you get a chance to sort of knock on a few doors or sort of chat to people when they're putting the bins out or whatever it might be, having those conversations, your gardens look nice, who manages those for you? Those sort of conversations I always find are very useful. They're much more informal, and actually they can be quite fruitful, really. So but as I say, in the absence of a statutory regulator, obviously it's very, very difficult. But as Sally pointed out, managing blocks of flats is also about managing people. And I know when Philip Rainey spoke to us last week, it's about democracy, isn't it? Your directors are elected to take decisions on other people's behalf, and if you don't like those decisions, then you put yourself forward for election, and then you try to change them and do better, really. So have I missed any questions there, Jackie?
No, that's all sorted, thank you.
Yep, lovely. Okay, so question number 3, very important question. What are the advantages, and is it absolutely necessary to take out directors and officers liability insurance?
So with director and officer liability insurance, it's there to protect the individual in their role as director or officer representing the company. So this is personal protection. This is why things like your health and safety reports are so important. If somebody trips up on the estate and they break their leg, they could potentially want to sue one of the individual directors for loss of earnings and for the accident itself. They may try to sue the company, but they could take a view to sue the individual director who is supposed to be upholding the responsibilities of the management company. So we do appreciate that this is an unlikely situation, and you would think that most people wouldn't try such a vindictive course of action. However, there is situations in the past that have created a need for this type of insurance to be put in place. So it's not that there's a legal obligation on anybody to take this insurance out, of course not. However, it is very much advised that for what is a reasonably low sum, generally just a couple of £100, maybe £300, depending on the size of the company, for the protection that then actually offers you in the roles that you do as directors on the board, it's certainly money worth spending to protect yourself. It covers liability insurance, covers the directors and officers or the company organisation if sued. D&O insurance claims are paid to cover losses associated with any lawsuits, including legal defence fees. But most policies will exclude if there's been fraud or criminal activity by the director, which we would like to think would never be the case, but it wouldn't cover them for any misdeeds on their part. What it does is it protects and indemnifies financially for issues that may arise where a external party or a leaseholder is trying to make somebody personally accountable for something that's affected them. So we would always advise, if you are a company, whether it be right to manage or resident management company, to protect yourselves in doing the job that you're doing free of charge for no recompense, and to help all the leasehold or all the members, who are generally all the leaseholders. So for your own sakes, we would advise that yes, you do take it out to protect yourself in the roles that you do.
I think that's a really, really good answer. Certainly, I've been a director of my block for about 25 years or so now, and I wouldn't do the role without directors and officers liability cover. I think, again, as Philip pointed out last week at the AGM, every block has the potential for one person that can actually bring a legal claim against the directors for the decisions they're taking. I think in the chat, I noticed, I think it was Ralph said about we've also managing agents, even big ones. The current one isn't perfect, but it's about managing the managing agent, because knowing what the priorities are. And I think that's a really, really important point. I think actually, if particularly for a RMC or an RTM as directors, you need to be very clear about what your priorities are, and communicate those very clearly to the service charge payers, because it's about managing expectations. Yes, Ali.
I was just going to say, if anybody's particularly unhappy, I can absolutely assure you that we would look after you very well. So do feel free to get in touch via the FPRA if you'd like to speak to me about how our services run and what we could do for you.
Excellent, and I think that's really good. I think that's a really, really useful point. There's a question there about recommending good insurance policy. Obviously we don't recommend specific companies. Certainly what I do in my block, I've got a broker who every year goes to the market and assess my building, my development, and our requirements for insurance. It's really, really important that obviously you're not overinsured, but it's also very important that you're not underinsured, because both can either cost you a lot of money, particularly if there's a need for a claim. It's obviously very important to have an independent valuation for the sum assured. And I think most people recommend about every 5 years. I think is the kind of recommendation where you have an independent. We did ours about 7 or 8 years ago, but we've had a desktop study in between, which kind of works quite well for us because nothing was substantially changed. But I think if there's been substantial changes within your estate or block, and most blocks don't have substantial changes because they're blocks of flats with the same communal areas since they were first built. But if there are significant changes to what's being insured, then it's really important that you actually get an independent valuation and have that updated from time to time, really.
And that'll be your building reinstatement cost survey for anybody that's heard that term.
Yeah, absolutely. Belinda is our insurance advisor. So if you've got any specific queries about insurance, to please drop us an email. But like lots of things, I think we touched on it earlier. It's very much a balance between actually, do you pay less in insurance, and in terms of premiums, and the balance with the if you need to make a claim, what's the word I look at, excess. Do you have a I know a few years ago we had a nil excess policy on our insurance, but actually all that did was it pretty much doubled our insurance premiums. So actually having some sort of excess for a claim is I would suggest quite a useful thing to do. But equally, if you've got too high an excess, actually that then becomes a bit of a problem, really. But we're rattling through the time as always. So is there any more questions there, Jackie?
Yeah, there's a quick question from Ralph. You mentioned directors and officers as part of the company. We sometimes call ourselves directors and other times officers. What is the difference?
Well, essentially, the directors are the ones that are officially named as directors by being registered on Companies House as either a secretary, treasurer, or director. An officer is essentially not really any different if they've been officially voted into that role. But you do also find that people will act in a committee member capacity, and they often will be described as an officer. And so the committee and the directors will be covered by the liability insurance. And so it's covering the people that are putting themselves forward to be responsible for the maintenance and management of the building.
And I think it's important that we are referring to limited companies here, whether that be a rights managed company or an RMC or an RMC resident management company, which you're registered with Companies House. The same thing wouldn't apply for residents associations, because also they wouldn't have the same legal responsibilities as those limited company directors. Question number 4, please, Caroline. Is there any way to keep annual building insurance premium rises to a minimum?
Well, so expanding further on what you've already touched upon there, Bob, quite rightly, yes, to balance off the premium versus excess, that is one way to keep them lower. But another approach that we do find many of our resident management companies and right to manage companies take is to assess what they will allow to be made as a claim on the building's insurance, which may seem unfair sometimes to the leaseholder who maybe gets rejected. But on the flip side, when you see the increases in premiums and the problems that it can cause, whereby, for example, if you have a building where you've had maybe 2 or 3 roof leaks over the course of 3 years, you'll find that your insurance will come through with a clause that says they want a roof survey done and proven that the roof's in good standard, otherwise they won't insure the roof. So for reasons like this, you do find that if it's a leaseholder to leaseholder leak and it's of a reasonably low cost in proportion to how big some claim costs can be, they may say that that's not a claim that they will allow to be made against the policy, because the policy is supposed to be in place for when the common parts causes damage to a leaseholder's flat. So those type of claims will be allowed to be made. But sometimes a right to manage company or a resident management company will take a view that if the claim is only going to be up to, say, £1,500 to repair what's inside the property damaged, that it's not going to go through the insurance, because by the time the excess has been paid, there's actually only a small amount extra that would have to be paid towards the total cost of remedials. And if that is the case, is it worth the increase to the premium? So it does also depend on whether the parts within the demised premises could be reasonably assumed to have been maintained better, or the leak seen by the leaseholder. So I've got a building where they don't allow flat to flat claims to go on the insurance unless the pipes involved are within the concrete flooring, and therefore you couldn't reasonably expect the flat above to have been able to get to that or know about it and deal with it. So it's something that would need to be really discussed as a company to make sure that the leaseholder members are happy with the decisions of the board in that regard. But when you look at the long term and you see how many buildings that constantly allow claims to be made, then come to a point where they're looking at premiums that are so high, or that their building has been deemed to be uninsurable because the amount of claims that go on. So these are the things that need to be considered, but certainly it can be utilised as a way to make sure your premium doesn't keep going up exponentially because your building is prone to a lot of leaks.
I think that's a really good point. And, building insurance is, but I think the key thing for me is openness and transparency with your leaseholders, you know, so they actually understand what's insured, what the excess is, and the implications of making a claim as well. You know, if there's lots of claims in a year, it's like with your car insurance or any insurance, lots of claims will lead to higher premiums the following year, and it's about all those sort of balances really, and actually, you know, making a small claim really may not necessarily be worth it.
And one thing that I would say to be very mindful of is, I know that sometimes leaseholders report there's sort of cracking on the floor, they think it might be leading to subsidence. Be very careful before you say the S word to your insurers. Be very sure if you think that there is any cause to be looking into subsidence, because once you say the magic S word, your premium will go through the roof until they establish whether there is or is not subsidence. I've had a couple of buildings in my experience where just coming up to premium renewal time, somebody reports that there's subsidence, it gets raised as a claim because we are required and obliged to let them know. And so the premium then goes up exponentially because they are dealing with a potential subsidence matter. And then 3 weeks after renewal happens, they realise there's no subsidence, it's closed, and they still have to pay that ridiculously high premium for the year. So be very careful with subsidence.
Really good point. Quick question there. Our building insurance covers all 7 blocks in our estate. Several of these have had repeated water leaks, while our block has had one flat-to-flat leak in 11 years. The number of leaks has caused the premium to increase significantly, which we contribute to. How can we avoid cross-subsidising the other blocks to our block contribution to the premium?
Well, depending on how the estate's made up, you may be able to ask to remove yourself from the general policy and have the block covered as a singular block. So just the leaseholders in that particular description. As long as it is a completely separate building, you would certainly have grounds to argue that that should be something they allow you to do. Certainly one of the estates that I was managing, not now, but in a previous role, there was 3 buildings in a row, and we used to arrange the insurance for all 3, but several years ago, the middle block had a similar thing where they didn't want to be accountable for the increases that was because of leaks affecting the other blocks. They actually extracted themselves, and to this day, as far as I'm aware, still arrange their own insurance for that block, even though the other 2 blocks are arranged as a buildings insurance policy together. So you may find that you could possibly put a case together for extracting yourself from the group block insurance, but it would, of course, depend on how your building is in comparison to the rest of the estate. As I say, if it's a wholly separate building, you may be able to convince them to at least consider that.
I think that's a really, really good answer, and I think that's really helpful actually. I think as we mentioned right at the start, of course, the lease is always a starting point. So please do drop us an email, and we can get Belinda, our insurance specialist, to look at that to see whether that would sort of work in your particular case, really. Okay, question number 5, I think we're ready for, aren't we? What happens if there are not enough directors to meet the minimum requirements of the RMC Articles of Association, and what can be done to ensure enough bodies are on the board?
So this is really important. If the Articles of Association are not met, then Companies House could take a view that they will close down the company, in the same way that if the accounts weren't filed on time and other criteria isn't met. So it is really, really important to make sure that there are enough people on the board. You find most articles require a minimum of 3. Not all of them do, and it can be bespoke. So what happens if you're in a situation where you've got 3 directors and one of them is selling and they want to move, and there isn't anybody willing to step up? So the managing agent can take on the role of company secretary, and that gives you technically 3 bodies on the board for the purpose of satiating the requirements of Companies House. It's not the long-term solution, and what would also be highly recommended is educating the leaseholders, and particularly focusing on some of the younger buyers that are maybe have a little bit more youth and vigour on their side, even if they don't necessarily have the time to consider stepping up onto the board. I think the biggest hurdle that management companies face when trying to muster up more enthusiasm is one of two things. If it's a very difficult site and there's a history of antagonism and dispute amongst neighbours, or issues with contention between the board and the members, you find in those situations you might struggle to get members on the board. And on the other side, you might find problems where there's a lot of older residents and they just don't want the hassle of because they think they know what being on the board involves. So where the managing agent can help is this: not only can we come in and take on company secretarial duties for the company, which can reduce the load for the other bodies on the board, the managing agent can make sure that the directors and officers have the information that they need about the roles that they do, so they understand and feel more comfortable. And so when you're looking for more people to come onto the board, providing some information to potential, well, to other members that are potentially could be convinced to come on the board, clear information, just explaining and outlining what the duties are. I think it's the unknown that frightens people about stepping forward. Letting them know about director and officer insurance that protects them, that gives them a bit more security, knowing that if they do put themselves forward, they're not just at the mercy of an unknown quantity. And so education and information, certainly asking the managing agent to step in and help, not only just as a body on the board, but also they can help you with mustering up the enthusiasm and explaining and educating people.
Yeah, thanks. Yeah, I think that's a really good point. We've got a question there. To totally agree. We go to so much effort and energy to when we have an AGM and less than 4 people turn up out of 21 flats. I have to say, having been a director of an RMC company for quite a long time, we've tried all sorts of things to encourage people to come to AGMs. I've stopped worrying about it now. Actually, I quite like it when less people turn up, because actually that means actually we're communicating well and people haven't got concerns. People are very busy people. People lead very busy lives, and actually, do they want to sit in a sort of a cold school hall on a winter evening, just to pat you on the back and say well done? It'd be quite nice if they did, but I'm also a realist, and they don't. Actually, if they're going to come out, they normally want to complain. Another question is, we had the situation this year when both directors resigned, but did not appoint new directors before their resignation. Subsequently, new directors were registered at Companies House, but as there has been no general meeting or extraordinary general meeting at this, they could be elected. It is unclear how these people became directors. Is it legal? And I think that probably is one to take offline, isn't it? I think. You've
just reminded me of something else, of course, which I meant to say just a little bit about under question 5. You can, of course, apply, you kind of have an extraordinary general meeting or a special resolution at a AGM to amend the Articles of Association, and you could reduce those numbers down to a level that you're always going to be able to capture. It's very rare that you'd only have one, and I wouldn't really recommend it, but certainly you could reduce that number to 2, which is probably a more manageable amount of directors to make sure that you've got involved.
Yes, really good. And Ralph just said directors can, of course, be co-opted by the board if the articles allow that they that they can't. Can they? Absolutely. And and we did that with the FPRA during lockdown. We co-opted a number of directors as well. Is it permitted and common to pay directors a fee? That's a good question.
So this is something that's quite contentious, but the bottom line is that yes, if it's a cost that's been incurred in the direct line of duty in their role as director for the management company, then costs are recoverable, and they are recoverable from the company funds. Often that is the service charge, because if you've got you find the company finances are linked to the service charge. If all the leaseholders are members, then it will often be the service charge that's relied upon to cover those funds.
But I think certainly what we do in my block, I've been chairman of company secretary for about the last 10 years, and I receive an honorarium, and it's not a significant amount of money. It's certainly not a salary, and neither would I do it for a salary. But actually, it does cover, a lot of costs and and some of my time. So I think it's certainly something worth considering. But if you're going to start paying directors, as well as having a managing agent, it would, I would question, why do you have a managing agent? If you're going to self-manage and put the responsibilities onto one or two people like we do in my block, then actually there does need to be some level of recompense, I would suggest, for that to function properly. Okay, I think we're ready for question number 6. Should we pay for capital expenditure plan for our building, and what are the benefits?
My advice would be yes. If you haven't had one done for, say, the last 10 years, it certainly should be done now, so that you can look to planning your expenditure in a reasonable and manageable way. Your capital expenditure plan will assess the life expiry of the various components within your responsibilities of the building, and to some extent the grounds, like drainage and things like that. And it will, what the capital expenditure plan should do, if it's a good one, will assess what your responsibilities are, how long it's going to be until they need to be renewed, the likely costs involved in those particular pieces of work. And it should also give you an idea of what year between however long your CapEx plan is. So these works should be done in year 1, these works should be planned for year 3. So it allows you to not only maintain your building effectively, but it also gives you the financial planning that is essential if you're going to make sure that your service charges and your reserve fund allow leaseholders to manage their finances and keep the building in a good state of repair. It allows you to predict when you're going to need major works done, which are always the biggest point of contention, because it means leaseholders finding a very large sum of money in a very short period of time if a proper cyclical plan hasn't been put in place to allow for you to capture a reserve fund at a reasonable collection rate.
Really, really important point. And certainly one of the things we highlighted in my particular lease was the lease in my block didn't allow for a reserve fund up until about 10, 12 years ago. And thanks to our FPRA legal advisors, we were able to actually identify that we didn't have a reserve fund. And actually we were able to amend our amend our lease rather, to allow for a reserve fund. It's absolutely essential when planning the long-term maintenance of your development or your building, to actually have a reserve fund. And in terms of what are the benefits, when we did it, we got a structural engineer when we took on self-management about 15, 20 years ago. We produced a 15 to 20 year plan. Of course, it wasn't, budgeted for in terms of X amount of money per each of those years, but actually it enabled us to identify all those things that needed doing, and then every 3 to 5 years we allocated money towards it. That enabled us in those 15 to 20 years to never increase the service charge above the rate of inflation. And in the last 5 or 6 years, we haven't increased the service charge at all. And we still manage a reasonable sort of cash flow every year. So the benefits are significant, and it's really important you have a well-managed plan, really. Question number 7, how should end-year credits be managed? Give them back to the leaseholders or add to the reserve fund?
So this is something that people don't always realise is actually quite prescriptive. So under the sections 18 to 30 in the Landlords and Tenants Act, it describes service charges and how they should be managed. As the default option, unless the lease specifically prescribes for the surplus to be handled in a different way, the default is that it should be credited back at year end, and that is an absolute given. There's often a misunderstanding that it's only the deficit that needs to be dealt with at year end. Yes, a deficit does need to be collected in, but in the same way, the credit should be reapplied to the leaseholders' service charge account. So they don't necessarily get a financial amount of money back in their bank, but it certainly goes against their service charge account to offset the next invoice. However, there are some leases, and it does have to be quite specific in the lease to allow for this. There are some leases that will specifically say that the surplus can be attributed to the reserve fund at year end. So the way to check is to check your lease and see what your lease says. In the omission of any specific reference to transference of surplus to a reserve, you assume that you must give it back under the general terms of service charge and service charge management. So you should give it back unless the lease says otherwise. So always check your lease, which is my first golden rule of leasehold management, is always know and understand your lease.
Yeah, I think that's a really, really important point. And actually, that's exactly what we did in my block when we contacted the FPRA to identify that we had a problem with the lease. And we actually amended the lease to do exactly what you said, Sally, to enable us at the end of the year end, we do put money that's a surplus into the reserve fund, because that enables us to hopefully keep the service charge to a minimum. I think we've got a couple of questions coming in. Somebody for end of year credits ? Do you mean a surplus? We've just reinvested it back into the accounts and also used as a reserve. I think the answer to that is simply yes, isn't it? But it's worth checking that your lease allows for you to do that, Umesh.
Because it can be challenged by any disgruntled leaseholders. So they may not ever challenge it. I've had these conversations with some new clients we've had this year where they didn't realise, and for years they've been collecting their surpluses as a reserve fund, and we've done the accounts for the first time, and I've let them know that there's X amount to give back in credit, and they've questioned that, and I've had to explain that in actual fact your lease doesn't allow for it, and I've explained what the terms actually mean, and that whilst nobody has challenged them yet, at any point in the future, up to quite a long period of time, it doesn't really have a statute of limitations on challenging when your service charge has been mishandled correctly. And I know this because a recent case at the first tier tribunal was assessing service charges from 2005, 6 and 7. So there is, whilst there is a statute of limitations to some things, it appears that that doesn't apply to challenging service charges, certainly not in the FTT's opinion. So unless you're handling your year-end deficits and credits in line with legislation and your lease, there is the potential for it to be challenged, and it could be decided by the tribunal that any year-end credit retained in the reserve fund actually should be given back to the leaseholder. And this is one of the things that needs to be considered before decisions are made of that nature. You always have to protect yourself. Yeah. And there could always be somebody wanting to be difficult.
Absolutely. I'm just going to say, if we get back our surplus, we would have been bankrupt by now. That's not a reason to put it into reserves. You can only put it into reserves if the lease allows. If the lease doesn't allow, you need to go through the process like we did of making it allow. I think is really important. And then there's another question in the respect that it's necessary to have certified accounts to calculate credit or deficits. Our lease says the accounts should be issued as soon as it is reasonably possible. It is now November, and our 2020 accounts still have not been issued. Is this a failure to issue the accounts 11 months after the close of the financial year reasonable?
So there's two things that really need to be looked at here. The first one is, are there any credits or are there any deficits? And then you have to look at the 18-month rule. So if there is a deficit on the account, if they have not served you a Section 20B to delay the official actualization of the accounts, if they haven't served a Section 20B and there is a deficit on the 2020 accounts, they've now lost the right to collect that back from the leaseholders if there is a deficit. If there is a credit, there is no time limit on when they are allowed to give that back. So if there is a deficit, there is a detrimental impact on the management company, really, and the managing agent, because the managing agent would have failed to look after the management company's responsibilities if they haven't served Section 20B to allow them the right to defer the finalisation of accounts. If there is, as I say, if there is a credit, there is no time limit. And so whilst it's a frustration and it's not particularly good management of the accounts, because why has it taken so much longer than the normal time frame? And that may be something that you want to consider. Is it the managing agent or is it the accountant who's not done their job for you particularly well there by going on so long? But there's nothing to force the accounts to be served, no. But if it's the company year-end accounts, there is, of course, timeframes that need to be adhered to in respect of registering them on Companies House. So if it's your service charge accounts only, then there is no limitations. If you've got a combined account where your service charge is contained within the company account, then that would qualify as a company account that should be registered. So it does depend on how your accounts are produced. And if you are specifically talking about just a separate service charge year-end account, or if you're talking about one that's combined in with the company account.
Thanks, Sally. Ralph's just saying he's having to leave the call. Are the recordings like this webinar available? Absolutely it is. And thank you for saying it'll be useful for other directors. John Ray will make this available within the next 24 hours or so, but it will only be available to our members as a members resource using your login from the website. Rod's asked a question, which I think is a very good question. If the accounts are agreed at the AGM, does this cover the surplus going into the reserve fund?
So it does. However, it's not part of the lease. It can still be challenged. And that is one thing that does need to bear in mind. Special resolutions, agreements at AGM, they hold weight for the company and for the members of the company. But as an individual leaseholder, you can separate yourself out from being a member, and separately, you're a leaseholder. And you can challenge as a leaseholder, even if you at the AGM agreed at the time, you have the right to change your mind and you have the right to challenge. And so it's, unless it's something that's set by the lease, you cannot guarantee 100% that it can't be challenged.
I think that's a really important point. And I think it's one of the advantages of if and when we move to common hold, because actually, as Philip pointed out again, our AGM, actually it's much more of a democratic process, a bit like councils, where councils, set your council tax, and as a council taxpayer, you've got to pay it because actually that's been democratically set by people who are elected to make those decisions. The difference with an individual with a lease is if your lease says that the people managing your building can't keep their service charge from year to year because there's no provision for a reserve, an individual will have the right to challenge that, and many do, and there's been some case law around that. So I think it's really, again, really important to check your lease, but always, if it doesn't allow for a reserve fund, I would always encourage blocks to make sure that it does allow. It's one of the best things I think we ever did, really. If service charge issued by question, if service charge issued but questioned raised on expenditure items not answered, should we still pay on time?
Sorry, could you repeat the question?
I know. If service charge issued but questions raised on expenditure items not answered, should we still pay on time? I think the simple answer to that is if the service charge is due, you are due to pay it. I think if there's, certainly my view would be that if that there's a reason not to pay it, then you have to follow due process, not pay it. What would your thoughts be on that, Sally?
So when it comes to, I think what you're asking me is withholding service charge.
Yeah.
So when it comes to withholding service charge, it's something that's frowned upon by most external bodies that regulate and would hear cases to FTT or court cases. But you do have the right to withhold an element of the charge that directly pertains to the service that's being disputed for the period of time that's under dispute, as long as you are making a reasonable payment to cover all the other liabilities that you are not disputing. So, for example, if you were very, very, very unhappy with your cleaning service and you really felt that your managing agent or your management company wasn't listening to you, then you could decide to extract the element of your service charge that is for cleaning and not pay that until the point that the dispute is resolved. It won't go against you, but it doesn't look good either. But it is it is a right of the leaseholder to hold a reasonable amount back, but only specifically for that service. And it would be something that you would be expected to keep that money aside, so that should the dispute not be upheld, you would then pay immediately what you've been withholding. But to officially have a dispute in that manner, you can't just say, I'm not paying you because I don't agree. You actually have to take the official steps to making an application to the first tier tribunal for them to make a decision over the fairness and reasonableness of that service charge that you are disputing. So there are some rights, but you have to be above board, and you have to still take into consideration, you have to pay your buildings insurance and other liabilities which aren't optional, regardless of you being in dispute or not.
Lovely, thanks, Sally. Question number 8, if that's okay, Caroline. Should our service charge year end be the same as our company year end? Good question.
So we find that sometimes you have an estate where you'll get the service charge accounts and they will be based on what's in the lease. And because the management company limited accounts, they will be based on the end of the month of which the company was incorporated. So say the company was incorporated in September, on say the 5th of September, so that first financial year will go past the 30th of September and up to the following year's 30th of September. So you often will find that your company accounts are not necessarily in line with the lease year-end dates. You can decide to change the dates of which you collect the service charge. It's one of those things that really comes down to how it's described within the lease. Sometimes you'll find the lease specifically says dates, but then it will also say, or at any other date at which the management company may see fit to change dates to. But there are some leases that only prescribe set dates, and where it doesn't actually specifically comment on being able to vary that, the only way that you can officially change it without it being unchallengeable is to vary the lease to change the dates. It's not the sort of thing that people generally have a problem with. And most leaseholders, in my experience, are quite happy to vote to change in that regard, or they will just have it as a special resolution passed at AGM or EGM, and it never gets challenged because everybody's happy for the accounts to come in with the same dates, because it's easier to understand, because the service charge to some degree links in with the company accounts. However, if your lease doesn't prescribe for it to be done, and you do get a special resolution, but you don't push that resolution through to varying the lease, which is often what a special resolution is there for. The special resolution opens up the forum for you to then make the changes officially through the legal channels. A special resolution would be enough if nobody challenged it, and it would be enough for you to say to the leaseholder, this is why we're doing it this way. But should they press to challenge it through legal channels, unless it is something that's allowed by the lease, like with most things in leasehold, it can still be challengeable by a particularly difficult leaseholder who maybe is not paying their service charge because we haven't charged it in accordance with the dates that are set by the lease.
That's a really good answer, and I think if you go back and look at various case law, there is a lot of case law around that as well. So it's really important that actually service charges are demanded and paid correctly in accordance with the lease, and as and where appropriate. And obviously our advisors can assist with that. We've got a document online actually about varying leases available free to members that you can download if anyone's interested in varying leases. Question number 9, please, Caroline. I'm conscious of time. Are you okay for time, Sally?
I am, yes.
Yeah, okay. Just checking that everyone, Caroline and Jackie and John, okay for time? Because we do try to keep these to about an hour, really. But we've got a few. Are you okay, Caroline?
Yes.
Yeah, I'm okay.
I'm okay. I'm okay.
Lovely, brilliant,
Yeah.
lovely. Okay, question number 9 then. It's a really great interactive session, actually. So this is another really good question as well. Number 9, when a leaseholder sells their flat on, should the last service demand be paid in full or prorated, and what else should be considered at this point? What does it mean for the incoming buyer?
So this is one that I deal with quite frequently, because we
Yeah.
find that, that solicitors don't always convey certain information to the incoming buyer and to the selling leaseholder. So with regards to the service charge demand, it's issued in the name of the person that owns the property. Therefore, that person needs to pay the full liability of that service charge demand. But what should happen is the solicitors representing each side, the vendor and the buyer, they're supposed to have a conversation about the cost of that service charge demand, and they need to pro-rata it between themselves, and they are supposed to pay the pro-rata amount to the vendor as part of the completion sums for the sale of the property. So for the resident management company and the managing agent, we expect the money to be paid to us by the leaseholder that owns it at the time the demand is issued. And if they sell 3 days later or 2 weeks later, it's up to the solicitors involved to get the service charge information from the LPE1 packs and calculate what the daily rate is for the month of completion, and then they pay the seller the amount of service charge for the period that the new owner will technically be responsible for once from the day of completion, for the rest of the period for which that demand related to. What else should be considered at that point is any year-end accounts that have not yet come back could have a credit or a deficit. There should be a retention agreement made between the solicitors for an amount extra to be held from the seller to account for any year-end deficit that may apply, which will of course have to be prorated to take away any of the deficit that would apply to the new owner for the last period of service charge for that financial year. And what this means is the incoming buyer doesn't suddenly have to pay the money for a period in which they didn't own the property, or for the period where they didn't own it for the full period. But it also protects the outgoing seller in the way that if there's any credit coming back, the retention agreement will mean that the credit has to be passed back to the person that it's due to. And so it's in both the vendor and the buyer's interests for their solicitors to make sure a robust retention agreement is made to account for any year-end accounts that haven't come back yet. So credits and deficits can be fairly attributed to the parties in the proportion that they should be. And if this is not done, the incoming buyer, from the point that they complete, they are fully responsible for all liabilities in connection with that property, regardless of whether it predated their term of ownership or not. So if there's a big deficit on the year end and there's no retention sum agreement in place, there is nothing in place legally to force the previous owner to step up and give the portion of money that they should, unless it's just down to the goodwill of that person.
Really helpful. Yeah, and I noticed from LinkedIn, actually, I think it was Nigel Glenn from Armour has just announced that the LPE1 form has been finally updated. There's been a lot of work gone onto it over a period of time, and so I'm hoping the new revised LPE1 form will certainly make it a lot easier. I know the number of times I complete an LPE1 form for sales in my block, and the solicitors come back with all sorts of questions that actually, I thought I've realistically answered, really. So hopefully that's helped. Question number 10, then. This is a complicated one. Could you kindly address the following issues: experience in accessing the building safety fund for recladding? Perhaps compare experience between right to manage companies, presumably no experience, and freeholder-led applications. Large freeholders may have a number of cases. Risk of becoming an RTM director, and is public liability insurance reliable?
So
I think Sally's frozen. Can you still hear us, Sally?
I can, yes. Can you see me?
Oh, lovely, right.
I think your picture's frozen, but we can hear you.
Hopefully not in some strange expression, because that's happened to me before, and I've ended up looking at a screen with a very odd face of looking back at me.
Not too bad.
So, the truth is that we don't actually have a great deal of experience in this particular arena just yet. The issue of cladding is, whilst it feels like it's been years since Grenfell and it's been on the topic of discussion for years, it's still a very slow, very rumbling process. It's still in its fledgling stages. I myself have not had to put any buildings through the to apply for the recladding fund. We haven't had any cases of that ourselves for us to refer to. And I did put the question to a group of block managers that I've got on a WhatsApp group with about 30 different block managers from different companies. And actually there's very little experience in successful applications yet. I'm finding that most of the people that are dealing with cladding are just at the point of making the applications and don't actually have any data on success rates yet. And it is something that we're just going to really have to play by ear and watch as it evolves. There aren't many cases that have actually been accepted yet. We know that it's a very skewed level of numberings, in that there's thousands of applications waiting to be heard at this point in time, compared to just a handful of 100 that have actually gone through and are then on to the next point. But until the applications have gone through that process and we see how it evolves, it's very difficult to offer any real advice that's going to be of any use, because we just don't know. We just have to see what happens as this unfolds, really. And I do apologise that we can't be more informative, because we appreciate that this is a real weight on the minds of leaseholders, and we assure you it weighs on the mind of block managers just as much, because we have certain levels of accountability and culpability in these issues. So really it's something that we're all seeking more advice and a bit more guidance on, and we're hoping that something with a bit more clarity is made available by the government soon.
Yeah, I would totally agree with that, Sally, and certainly one of the things the FPRA have been doing over the last year is working with the Home Office on the Fire Safety Act, which the regulations are due to come in force at any point. It is now an act of Parliament, but the regulations haven't brought the new law into force yet. And the implications for not only on that act, but also the building safety bill that's going through Parliament at the moment, which is going to place a number of restrictions, and it will also be creating a new regulator for building safety as well. And the FPRA are very involved with the Health and Safety Executive that are likely to be appointed by the bill when it becomes an act next October. And the FPRA will be very much involved with that regulator on behalf of residents. Certainly the Select Committee of the House of Commons did some work on the likely cost and the amount of money available from Treasury. There is a significant gap between the amount of money available from the Treasury and the likely costs to remediate buildings. So it's something that we're sort of working very closely on, really. But do please drop us an email. Jonathan Goff, one of our directors, is also a health and safety expert, and he can answer any specific questions. Just going back on another topic in the Q&A about general meetings, I'm not sure if you will cover this, but I would like to ask the following question. The minutes of our estate's last general meeting were written by our agent after the directors who officiated at the general meeting resigned and have not been signed off by the ex-directors. The minutes omit several important topics that were discussed at the general meeting that the agent does not agree with. How can the minutes be challenged at the general meeting when they are brought forward to vote to approve them, raise a point of order, or do we need to submit a written motion?
Well, certainly you don't have to accept minutes that people don't agree with. And I'm just trying to think what your best course of action would be in that regard, but certainly do not agree to sign off minutes that people do not agree with and don't believe truly reflect the actual activities of the AGM. Have you had any explanation from the agents as to why they don't agree? I think that you'd need to look at this on a sort of case-by-case basis and dissect what the issues are that haven't been included. It might be that there are certain liability factors that they're having to consider, and it may be that the information is inflammatory in some capacity and they're mindful of what to include. But as I say, it's difficult to really advise clearly on this without knowing a bit more about what the issues are that haven't been put in. Because when you type up minutes, if you've had, say, a particularly contentious AGM and there's been some quite aggressive scrapping between leaseholders, members. I mean, I've been at AGMs where it's nearly ended in fisticuffs, and you've sort of almost literally had to separate people. And you have to make an educated guess. You have to make a judgment call about what is appropriate to leave in minutes and what is actually more appropriate to omit from them, albeit it was something that happened at the meeting. So, I mean, I'd be quite happy if somebody wanted to send that in as a query as a member, then I can certainly look at that for you. But I would need just a bit of detail about what hasn't been included, and if there's any sort of disputes between board members, and if that's what led to there being no longer board members.
I think that's great. Yeah. So if I can ask our anonymous attender, just the agent was not prepared to engage with leaseholders on a block-by-block basis on major works and reserve fund shortfall with the block was specific. So I think if you could drop us an email with that, and Sally will undertake to deal with that one offline. Question number 11, please, Caroline. Not-for-profit management companies do not have business interests, so any terrorist incident would not involve commercial business interruption. Surely the freeholders who profit commercially from this residential site should be expected to pay at least part of the terrorism insurance levy. Good question.
So it would depend on whether you've got any commercial units within what's described as the freehold, and that which contribute towards the service charge, shared services. If you've just got a block of flats, terrorism insurance does still count as a requirement, particularly for London-based blocks. Often in Greater London and the wider counties blocks as well, if it's in a built-up area, terrorism insurance is something that didn't have a need to exist many years ago when I first started doing leasehold management. I don't think I'd ever heard of terrorism insurance for a good 10, 15 years, but after events that have unfolded in the turn of the 21st century, it's become something that insurance providers do require to be in place. And it's not just to protect the commercial element of income for the freeholder, etc. It means that if an event that qualifies as an act of terrorism causes harm and damage to your property, it will be covered. Whereas if you had just your standard buildings insurance, an act of terrorism is not necessarily covered by the property. So you might sustain damage from a terrorist bomb. That means you need to rebuild a big section of the property wall. It won't be covered under a claim unless you've actually got terrorism insurance that goes hand in hand with the buildings insurance policy, unless it's a combined policy, of course. But certainly in the modern environment, terrorism insurance is something that if your block's insurance isn't requiring it just yet, don't be surprised if it does suddenly become something that they insist upon you having. Certainly, I've got all of my blocks over, I'd say about 30 flats are required to have terrorism insurance in this modern day and age. And so even if it is a really unlikely inevitability, just be mindful that your insurance company may require it, because it's pretty much standard fare now for the insurance arena. They require it for all London properties. They require it for properties of a reasonable size in Greater London, and certainly any built-up cities. If you're a block in a built-up area, I would be surprised if it's not something that becomes applicable soon, if it isn't already, if you've got at least, say, 25 to 30 flats in your building.
Lovely. Thanks for that, Sally. And I think that's a really, really important question. And if anyone's got any specific queries about that, do please let us have a copy of your lease, and we can put that to Belinda, who's our insurance expert, who can deal with any sort of detailed specific queries on that. Question number 12, Caroline, please. Estates suffering the consequences of poor workmanship in the original construction continue to pay a high price for essential repairs. should the freeholder have a responsibility towards ensuring the value of their investment by contributing towards repair?
So on a moral basis, you'd say yes, but on a legal basis, generally no. So what indemnities you do have is that you will have your 10-year build warranty. So any defects or poor workmanship should be picked up and identified and raised as a claim within the first 10 years. And therefore there is accountability to some degree for those defects to be resolved without it necessarily having to impact on the leaseholders. However, it does depend on how old your building is. And if you're in an older stock building and you're talking about inherent poor workmanship that's 15, 20 years old or longer, unfortunately, there isn't really much that can be done. And under the terms of the lease, unless your lease says otherwise, all maintenance responsibilities are passed on from the freeholder to the leaseholders or the management company, who obviously the leaseholders all contribute towards. And so therefore, technically, the leaseholders pay, the management company deals with the maintenance. So unless there is a cause for the freeholder to have a responsibility, then they will always extract themselves from any need to contribute, because there's nothing legally pressing on them to make them contribute. The only thing that could fall slightly outside of this, where they may deem themselves not legally responsible to do so, but certainly for their own equity investment and value of their property, if there's improvements that aren't covered under the terms of the lease, but that are something that they would like for the benefit of their freehold, then you might find that there are some issues that they might be prepared to contribute towards. But the bottom line really is this: the lease puts the responsibility of the freeholder for the maintenance and the upkeep onto the leaseholder. So unless you've got a valid building warranty in place, there is nobody else that can help the leaseholders pay for looking after the building. It is unfortunately one of the pitfalls of leasehold, is that you take on the flat and by proxy you become a member of the company, and the member of the company is responsible for everything, because that's how the freeholders will write the leases, or have their solicitors write the leases, should I say specifically.
Yeah, there's a very specific question about liabilities in the chat on insurance. I think we'll deal with that one offline. If I can ask the office to pick that one up on email, and I think we'll respond to you in email on that one. There's very specific things about limit, which we haven't really got time to go into in detail on a webinar. But I think it's a really important point about the issue about the difference between repair and improvement as well. Most leases, for very good reason, don't allow the service charge to cover improvements, because obviously that's something down to the freeholder. One of the real contentious issues around improvement at the moment is electric vehicles. Electric vehicle charging infrastructure is at the moment, in our view, classed as an improvement, and therefore can't be charged to the service charge. At the moment, there are no 100% grants available. So at the moment, it's virtually impossible to actually bring forward a situation where an electric vehicle infrastructure can be put in. Sean O'Sullivan, one of our honorary consultants, and myself, we're having a number of meetings with the Department of Transport and others, and there'll be an article in the newsletter shortly about that, because it's a really, really important issue. But as soon as 2030 comes and people can only drive a electric vehicle and no other vehicle, then it won't be an improvement, it'll be a repair and maintenance, because actually people will have to. So watch this space on that one. Question number 13, please, Carol. Changes to current environmental policies are already impacting on the life of residents and owners. Should freeholders contribute towards safeguarding their investments and helping to maintain their future viability?
It strikes me that this is very similar to the previous question, and it again goes back to the same things. If the changes in current environmental policies are creating what you'd call effectively an improvement, rather than something that would be considered maintaining something that's already in existence, then it's down to whether the freeholder wants to contribute towards that improvement or not. There's nothing to force them. But certainly, if it's a policy that's been set by the government, then there will be an obligation to uphold said policy. So it really does come down to whether it's something that is, if the environmental policy that's being put in that creates the change, is the change being created something that is a improvement or could be deemed as an area of improvement to, it's not an existing service that's managed and dealt with. You see what I mean? It's difficult to say without being more specific on this one, but I do think it's pretty similar to the answer to the previous question, whereby the freeholder should contribute if it benefits themselves, but there's nothing to force that contribution unless the issue that we're describing is something that's a statutory obligation that's being placed by the current environmental policy changes. If it's a statutory obligation and it comes down to something that isn't something that's already within the remit of the management company to manage, then yes, there could potentially be onus on the freeholder for them to have to contribute, as opposed to a voluntary contribution.
Yeah.
As I say, hard to say more without more specifics, but as a general, that's your boundaries that you'd be looking at and your things that you'd be considering and what they'd be considering in that sort of situation.
Yeah, I think that's really important. A good example actually would be about 10 years ago, the government implemented digital switchover, where they switched off analog TV signals, and therefore it was clearly reasonable that the service charge would have to cover costs to communal TV distributors and things like that, because the analog didn't exist anymore. And actually, it's a and the European Court of Human Rights actually identified that it's a human right to have access to TV and things. So that's kind of one example. But
and moreover, the lease has probably said that the lease has probably stipulated a TV system if it's unless it's a very, very, very old lease. And if the lease stipulates the provision of a TV system, well, in the removal of one that functions, there is an obligation to have provided one that does function with the modern setup. So yeah,
absolutely. Yeah, and I think that brings us to our next slide, which is our last slide. Apologies for everyone for going over time. We do try to keep these to an hour, but it's been really, really interactive. I just noticed one last question as well in the chat. If the building's less than 10 years old, should any major cost item, e.g. roof or intercom, that require a repair or replacement be covered by the freeholder, i.e. the owner?
It's wouldn't necessarily be covered by the freeholder. It'd be coming down to the building warranty and whether the issue that's been found is actually something that's a latent defect, or whether it's happened due to mismanagement or just day-to-day general failure of the equipment. So, for example, the door entry system itself should have some sort of manufacturer's warranty on it. So you wouldn't necessarily need to rely upon the building sign-off certification for that. But the roof, why is the roof failing so quickly? A roof would have an expected life expiry. As I mentioned for the CapEx plan, you'd expect the roof to last for say 15, 20 years. If it's failing well within that boundary, you have to look at why. Is it something that's been damaged due to say a storm or a one-off incident? Or is it down to there being a latent defect that wasn't picked up at snagging and has only become apparent over time? So, for example, if there was a defect in the roof construction that was allowing a leak to come through, but it had to track through so much it's taken 6 months after build or 2 years after build for it to become apparent. What needs to be established is if it's a latent defect. If it can be classified as a latent defect, you can rely on the building warranty, the first 10-year warranty, to push back on whoever the warranty provider is, because it's not always the same provider. If it's not considered a defect, then it does have to be dealt with under the general service charge, unless there's a manufacturer's warranty, like there would be for the door entry system.
Excellent, excellent full answer there. And again, if you're not sure, do please drop us an email and we can get a more specific response, having sort of looked at people's lease. I think we're coming to our last slide there, Caroline, I think now. Again, thanks to Sally for a life in block management in about an hour and a half, which was incredible, really. And thank you everyone for the interaction as well. It's been great to have you with us, Sally. The dates for your diary, so we're looking at next Thursday the 9th of December. Vice Chairman Shulerich and myself will be doing a webinar on committee and board meetings, so do please get your questions into the admin office for that now, and details will be coming out to you via email in due course. But I say that does bring us to the end of the rest of the session and the recording. As I mentioned, John will have this available very shortly, within the next 24 hours or so, on our members website. So you'll be able to go back and whiz through and catch the webinar again at your leisure. So again, thank you ever so much for joining us, Sally. And if I can ask John to end the recording now.